This conference will now be recorded.
Good evening, everyone, and thank you for joining us. I am Zachary Taylor, one of First Northern Credit Union's business development contacts. Today, we have Director of Sales David Tognarelli presenting the webinar, Understanding Credit. Everyone should have received the handout that was emailed this morning. If you did not, please let me know in the chat box and I will resend it to you. This presentation is part of our monthly financial wellness program here at First Northern. We will follow up with an email tomorrow with additional materials that will be presented today. In addition to our monthly series, we have partnered with the City of Evanston to present weekly financial webinars. If you're interested in that particular schedule, please let me know again in the chat box and I will email you the details. Throughout the webinar, if you have any questions, please ask them in the same chat box to the right and David will address them at the end of the presentation. And with that, I will now turn it over to David.
Great. Thank you, Zachary. I appreciate the introduction and welcome everyone to today's webinar on understanding credit. We're so happy that you're able to join us today during the lunch hour. We hope you find some value in the information we present. And if you have any questions, let us know in the chat box and we'll be happy to address them for you at the end of the webinar. Okay, so understanding credit. So the webinar today will cover a few items, starting with what lenders look for when approving credit, when considering whether to extend credit to a potential borrower, how credit is scored, so we'll dig a little bit into the FICO scoring model and the different weighting factors that make up that model, and the impact that money management can have on your future credit standing. So a little bit about budgeting and setting up some financial goals for the future. So by wisely acquiring and using credit, you can definitely give yourself a tremendous tool to help you achieve your financial goals. And that's what we're after today in the webinar. So why does good credit matter? So when used wisely, credit is a helpful and important financial tool. So if you have good credit, you'll be eligible for the best interest rates in terms on car loans, mortgages, credit cards, and personal loans. And then were you aware that your credit history can also affect other aspects of your life, such as the cost of insurance premiums or even whether you're eligible for those insurance policies, the ability to get a job, so potential employers are checking credit these days before extending an offer of employment, or even to rent a home through a landlord, they may check your credit. Okay, so your credit report. So the role of credit bureaus is to compile information that is sent to them from creditors and to provide credit reports to businesses that have a legitimate business need. So the three major bureaus are Equifax, Experian, and TransUnion. And because these bureaus are all private individual companies, use of the information contained in each report may vary. So credit bureaus are required to report accurate information since businesses rely on the reports to make good lending and other business decisions. So it's definitely important to note the power of time. So negative information on your credit report does not stay forever. For example, evidence of lawsuits, judgments, liens, foreclosures, Chapter 13 bankruptcy, and late payments to creditors will only remain for 7 years. One exception is a Chapter 7 bankruptcy, which could be evident for 10 years. The good news is positive information on your credit report can be reported indefinitely. Now, because many people may have problems with collection accounts, it's good to know that no matter how many times a collection account is sold, the longest it can remain on your report is 7 years from the date of the first delinquency with the original creditor. Most popular credit scoring models will also emphasize the recent payment information over older negative information, so that information won't affect you as much as time goes by in the future. Credit scoring. So lenders use credit scores to help them evaluate and price applications for credit. These scores are determined only by the information that's in your credit report, and it's basically a predictive of future credit performance, such as payment history or credit usage. The FICO score, which was developed by the Fair Isaac and Company, is the most commonly used and popular credit score. FICO scores range from 300 to 850, and the higher it is, the less risk to the lender. So people with high scores have an easier time getting credit and will be eligible for more favorable interest rates. So let's break down how the score is weighted based on different factors. So the highest weighted factor is the payment history, representing 35% of the weight of your credit score. Meaning, if payments are on time, so no longer than 30 days after the due date, that will have a positive effect on your credit score to the tune of 35% of the weighting. Then conversely, if they're late, whether it's a 60-day late payment, a 90-day late payment, or 120 days and beyond, both the severity and recentness of the late payment will have a negative effect on your credit score to that 35% weighting. The next highest weighted factor in your credit score is the amounts owed. So total amount of credit outstanding represents 30% of the weighting, and the higher the number is, the more of an adverse effect on your credit score. Conversely, the lower the number, the more positive effect it will have on your credit score. Third, at 15% weighting, is the length of credit history. So this length is measured as an average across all of the open trade lines you have in your credit report. So only open and active trade lines will factor into this average. So we will discuss a little bit later on why it might be a good idea not to close those oldest open accounts you have with creditors. Then tied for last is new credit at 10% and types of credit used at 10%. So we'll start with types of credit used. Basically, the more of a mix you have in your credit report between different types of credit, whether it's auto credit, credit cards, personal loans, or mortgages, the more of a positive effect you'll have on this 10% weighting of types of credit used. Conversely, if you have a limited type of credit, only one type, whether it's revolving on its own or just a student loan, then you'll be limited on this factor at 10% as more of an adverse effect on your credit score. Then finally, new credit represents 10% of the weighting of your score as well. So this would be where inquiries would show up in the last 24 months, a hard inquiry when you're applying for credit or applying for a job or applying for an apartment. And then after 24 months, those inquiries go away. Also, the longer in the past, the further in the past those inquiries are, the less of an effect they'll have on your credit score in this 10% weighting. Along with inquiries is also the recentness of open trade lines. So if you have fresher open accounts with new lenders, they will have a little bit of an adverse effect on your credit score up to the 10% weighting until those accounts age over time. So it's important to know many people will focus their attention on the relatively minor scoring factors, such as inquiries, like we discussed, rather than the biggies, such as making timely payments or really working on paying down your debt and keeping it to a minimum. Okay, so let's talk about some ways to improve your FICO score. So it's important to know that your scores will change with credit activity. So if you're not satisfied with the way your score looks today, you can change it by adopting these positive actions. First and foremost, pay on time every time. So do your best to always pay by the due date, avoid that late fee, and then by all means, do not let 30 days elapse after the late fee before you make your payment. Second, reduce your debt load. So come up with a plan, and we'll talk a little bit about your budget and working on getting a cash flow in place, leftover income at the end of each payment pay period, and work on a plan to pay down your debt load and reduce it over time to help improve your credit score. Third, limit the number of open accounts that you have. So that's going to keep those open accounts aging, getting older, having a positive effect on your length of credit history, and also doing your best to avoid inquiries if at all possible. Fourth, keep your old accounts. So those accounts that you've had established the longest with creditors, keep them open and active. That way they'll have a nice positive effect on the length of credit history scoring factor we discussed. Fifth, avoid maxing out accounts. So one measure of your credit score is your debt to credit ratio on your open revolving lines of credit. The closer you are to 100%, the more of an adverse effect it's going to have on your credit score. So if you can keep your balances significantly lower than the limit, starting at 50% or less and then shooting for 30% or less, and ideally 10% or less, the more of a positive effect that's going to have on your credit score. Sixth, do your best to avoid unnecessary balance transfers. So everyone knows that the 0% balance transfer offers are out there, but do your best to weigh the pros and cons. There may be a fee associated with transferring the balance, and you may just be able to come up with a plan to pay that balance off without having to open a new line of credit with a new inquiry on your credit report. And that's the last tip here as well. Avoid excess credit applications. So before you decide to apply for new credit, shop around. See which lender might be a good fit. See, what type of relationship you're going to have with that lender. Are they going to provide good service? Are they local? Are they someone that you can count on to be around in the long term? And once you've done that research, pick one place to apply for credit in order to limit the number of credit applications you perform. Okay, so moving on to establishing or reestablishing credit. So there are steps that you can take to establish or reestablish credit. First, a quick fix to any damaged report is to pay off old debts. So if you have collection accounts or charged off accounts on your credit report, do your best to pay those in full. You can also contact the creditors or collection companies and make arrangements or offer a settlement. Perhaps they can eliminate fees or reduce interest that was added onto the account. It doesn't hurt to ask. Second, try applying for a secured credit card. So with a secured credit card, funds are held on deposit as security, and a credit card is issued with a line of credit equal to the amount on deposit. This presents less risk to the lender, and over time, as you keep the account open and in a good status, you may be able to qualify to turn that secured credit card into an unsecured credit card. Third, you can ask a friend or family member who has good credit history to co-sign on a loan or credit card with you. However, be careful when using this option because late payments on the account will show up on both credit reports, whether you're a co-signer or the primary responsible borrower on the account. Also, it's important to know that many credit reports contain mistakes, so you should do your best to review them at least annually to make sure that all information on your credit report is accurate. And that's one free service that we offer here at the credit union. So if you want to take the time and sit down with one of our financial service advisors, we'd be happy to review your credit report with you in detail and ensure all the information obtained is accurate. Okay, so next, beware of credit repair. So some companies out there will claim to repair consumers' credit reports, and this is often for a very high fee. Now, what they may do is dispute negative, but also accurate information on your credit report. If the credit bureau is unable to investigate the claim within 30 days, the information is removed temporarily. Now, this rarely works, since they are generally able to respond in time, and even if the information is removed due to a backlog of requests, it will be re-reported by the creditor later if it's found to be accurate. Other credit repair companies may issue consumers a new identity. So this comes with a tax identification number to use in place of your Social Security number. This practice is illegal, so you should steer clear of it. Basically, there is no legal way to remove accurate and timely information on your credit report, so the steps that we talked about earlier are the best way to go to improve your credit in the future. Okay, the role of money management. So learning to manage your money is vital. By designing a realistic spending plan, you will be able to avoid using credit to supplement your income and make up the gaps at the end of each pay period. Since so much of a score is based on your payment history, part of every good money management system is knowing exactly when your bills are due and never making a late payment. Also, excess cash should be used for making good on old debts. So if there is not enough to pay the debt in full with your current income and expenses, see if you can cut down on spending or increase your income so that you can in the future. Also, all healthy money management plans include an emergency savings account. So do your best to put together 3 to 6 months worth of necessary expenses so that you don't have to turn to credit when an emergency arises. Tracking where it goes. This part is so key. So does everyone know where all their dollars go each month or each pay period? Have you ever wondered how that $40 fast cash withdrawal from the ATM can disappear so quickly? So it's important to be aware of where and how money is spent by tracking your cash flow, and there are several good methods to do this. One is to carry a small notebook, and the most popular version we have is our smartphone, right? And record the date, item, and cost of every single purchase you make. Another good method is to keep receipts from every purchase and then tally them up at the end of each day. Third, you could use a credit or debit card, always the same card. This gives you a nice, handy electronic record of your expenses through your online or mobile banking. Fourth, make sure you monitor ATM use. And besides ATMs, also those quick pay services that are out there where you transfer money to friends or family members. Try to become aware of how often you go or how often you use a quick pay service, and then how quickly cash gets spent once it's in your pocket. Finally, there's many popular computer tracking programs out there for long-term tracking. One example is Mint.com. The credit union also has a personal financial money management tool with our online and mobile banking. So these are great options, but they will only work if you use them consistently over a long period of time. Okay, living within your means. So living within your means may seem like a simple common sense thing to do, but it can be challenging. Now, I do realize that the first point here is the tougher one, increase income. So if you can, and there are opportunities, try to work some overtime if your employer offers that. You could also get a part-time job or a better paying job. Put yourself out in the market and see what types of jobs may be a better fit for you. You could look for opportunities at your current employer and set yourself up for a promotion when those opportunities arise. Fourth, you could sell assets to pay down debt. So there's lots of great online kind of garage sale type avenues out there these days. If you have things sitting around that have value, consider putting them up for sale. Second, prioritize your spending. So most of us have at least some expenses that we can reduce or even eliminate. Fixed living expenses are generally more difficult to adjust than those discretionary kind of daily expenses that do vary. You should analyze what in your budget can be postponed or even substituted. So if you have a large purchase that you want to make, see if you can save for it over a period of time instead of spending all the money at once in an impulse type situation. Okay, delete your debt. Everyone wants to do this, right? So excessive debt can derail any budget. Try living a cash-only lifestyle, meaning you're only spending the money that's coming in from your paycheck or other income sources. Close accounts you don't need and keep emergency cards at home rather than in your wallet. So here we're trying to reduce the temptation of using credit cards when we don't need to. Now there are two basic methods of effectively and efficiently repaying your debt. The first is to increase your payments, simply if you can, to pay more to your creditors each month. The second, not always as obvious, is to reduce those interest rates. So if your credit rating is good, you can even call your lender and ask for better rates on your current accounts. You'd be surprised. Sometimes they may say yes. I know before I talked about not going this route, but transferring balances to lower rate accounts could be a good option for you, whether it's with an existing account or if you seek out a new account and the terms and conditions and pros outweigh the cons, then go for it. Another great consideration is to use a low interest rate home equity loan to consolidate and pay off high interest credit card debt with one fixed monthly payment and a light at the end of the tunnel for the term of the home equity loan. So what do? Do I repay debt or do I save for goals? So the answer is you try to do both at once. So jumpstart on establishing any healthy money management habits. So work on that budget. Find those places where you can reduce or eliminate discretionary and unnecessary expenses. Savings can also be used for unexpected expenses and down payments for other financial goals. This way you won't have to rely on credit for emergencies, and you're really working on promoting good habits over the long period of time. Okay, so we've covered a lot today in the webinar. So now it's about action. So what are you going to do? So think about what can you do today? What habits can you realistically change? Then in the next 3 months, what's your plan for the short period, whether it's having that emergency savings account going or starting to pay off some of that credit card debt? And then look out towards the end of the year. What can you do this year that can help improve your credit history and those habits that we talked about? If you employ action after today's webinar, I'm positive that you can meet your goals and use credit wisely. And please rely on the credit union. We're here as a resource. We're a free resource. We're happy to have open-ended discussions with anyone about your specific situation. Besides the credit union, we have a great financial education website located at evanston.balancepro.org. There's also one located at fncu.balancepro.org. Through this website, there's many great tools like videos, podcasts, articles, e-learning modules to help you self-educate. There's also great counseling services. So those counseling services are free. They include money management counseling, debt repayment options, free credit report review, and more. So please check it out. And that concludes today's webinar on understanding credit.
Thank you so much for that, David. That was very informative. We did have a few questions that came through during the presentation there, so I'm just going to go through it in order. And if anyone has any additional questions, feel free to ask them in the chat. If you need a more complex answer, anything like that, please feel free to reach out to myself, David, Pete, anyone in the business development, and we'll get back to your question if we need to on there. Okay, so the first question we had on there, they asked, do you have any programs that can help reestablish credit?
We do. We have a great program. It's called Credit Sense. It comes with a savings plan, which you make payments towards over a 6 to 18 month period. And simultaneously, you're building up a savings account and putting positive credit information out there to the credit reports.
Okay, perfect. So the next question, I believe they're talking about the debt to income on there, but they asked the best ratio of outstanding debt to overall credit limit was in the 40% ballpark?
So just to be clear, your debt to income ratio cannot be measured on your credit report since your credit report does not contain your income. And that's the denominator for the debt to income ratio. However, the debt to credit ratio can be calculated through your credit report. And that is your total outstanding credit card debt versus your total balances available on your credit cards. If you can, try to keep that below 50%. That's when you're going to start to see that that ratio have a positive effect on your credit score. But even better is below 30%. The next level would be 10%, and ideally 0.
Perfect. So the next question they asked, could you please explain a little bit more in detail why inquiries have a negative impact on credit report? They said they get so nervous when someone wants to run it and they're looking to buy a house or condo.
Great question. So if you are interested in applying for a mortgage in the near future, it's absolutely a good idea to limit those inquiries on your credit report. Now, the reason they'll have an adverse effect on your credit score is part of the algorithm is assigning risk to those people who are applying for credit. So if you're applying for credit, then there's a certain level of risk presented to a new lender because you have either additional outstanding credit or you're seeking out credit. Perhaps you're not living within your means and you're needing to apply for new credit cards. And so that's why those inquiries will present risk and have an adverse effect on your credit score.
Perfect. I hope that answered it for you. Again, if you need anything else, reach back out. The next question on there, you made mention that the credit union will talk to us about certain things. Will you sit down and go through our credit report?
Absolutely. So free of charge, we're happy to sit down with you one-on-one and review your credit report in detail, make sure all the information is accurate, and even talk about tips to help you improve and get things on the good track.
Okay, perfect. Next question was, when you pay off a debt, for example, a car note, how long does it take for it to impact your credit score? They said they paid off a car note in April, and we're kind of wondering when that would show the effect.
Sure, sure. So it definitely depends on the lender because every lender is going to report to the bureaus at different times of the month. Typically, it does line up with your statement cycle. So once that lender does report that the account has been closed, that's when it will affect your credit score.
Okay, perfect. So the next question that came in was, is your mortgage balance included on the debt to credit ratio, or is it just credit card balances?
Great question. No, the mortgage balance is not part of the debt to credit ratio. So only open revolving lines of credit, both the balance you owe and the available limit, factor into the debt to credit ratio from your credit report.
Perfect. So I'm going to give it a couple more seconds. Okay, we have one final question that I see coming through here, and it says, how do you, as in First Northern, determine what the credit limit for a new Visa card would be?
That's a good question. So everyone is definitely considered on a case-by-case basis. I will say that typically we don't look to exceed twice your monthly gross income. So if your monthly gross income is $5,000, the maximum limit we would consider would be a $10,000 limit for a Visa credit card.
Perfect. Okay, that was our last question. I want to thank everyone again for joining us. We always hope you walk away with a little bit more knowledge on the subject that we present, and at the very least, remind you of some of the basics that you may have already known. We will follow up tomorrow with the PowerPoint presentations that we went over today. Please feel free to email any additional questions that you may have had, or if you come up with some later. I will let David have the final word, but I want to wish everyone the best of health, wealth, and positivity. And thank you, and have a great rest of the day. David?
Yes, thank you all for coming. I hope everyone is staying happy, healthy, trying your best to be optimistic and smile every day. And we hope that you can join us for future webinars. So please check out fncu.org/seminars for more information about our monthly workshop series. And then here in the city of Evanston, we have that specialized weekly series that Pete mentioned at the beginning, or Zachary mentioned at the beginning. You can find information about those webinars at fncu.org/Evanston. And with that, I hope everyone has a great rest of the day. We're 2 days away from the weekend. Enjoy the weekend. Do your best to get out and practice safe social distancing and enjoy the weather at the same time.